Sir Isaac Newton invented calculus and mapped the laws of motion. But in the spring of 1720, he bought shares in the South Sea Company during a massive market frenzy. Unable to calculate the madness of the crowd, he let his emotions take over, bought in at the peak, and lost the equivalent of 3 million modern dollars. Today, highly educated professionals, corporate executives, successful business owners repeat that exact 18th century mistake. They assume their high incomes and raw intelligence will easily translate into stock market success. But career success offers zero protection against emotional investing. In fact, the aggressive drive to constantly outsmart the market is precisely what ends up destroying an investor's wealth. Take the typical high-earning corporate executive or the veteran business owner. They might have tens of millions of rupees in accumulated assets, yet when they run the math on their future lifestyle, they realize they are staring down a severe retirement shortfall. A major reason for this gap is their heavy reliance on physical real estate. Many affluent investors lock the vast majority of their net worth into residential properties, operating under the false assumption that housing prices guarantee endless returns, only to find their capital trapped in a stagnant, illiquid market. When they do turn to equities, they treat the stock market like a casino. They chase office rumors, swap stocks based on unverified tips, and frantically try to time the exact tops and bottoms of market cycles. This high-speed trading hides silent killers. Every time an investor churns their portfolio, brokers siphon off commissions and fees. Over decades, these compounding transaction costs, combined with the relentless drag of inflation, slowly bleed the portfolio dry. The frantic pursuit of maximizing returns is the exact mechanism guaranteeing failure. To actually preserve and grow capital, investors need a completely different, counterintuitive approach. In 1984, a wealth manager named Robert Kirby made a fascinating observation. He discovered that a client had amassed a staggering fortune for one simple reason. Her husband had purchased a portfolio of stocks a decade earlier and then entirely forgot to ever sell them. Kirby called this the coffee can portfolio. The name comes from the American Wild West, where people, lacking reliable banks, would hide their valuables in an old coffee can and slide it under a mattress, leaving it completely untouched for years. You can't, however, put just any random stock into a modern coffee can and expect to get rich. You have to identify the corporate equivalents of the Roman Empire, businesses so durable and dominant that they can survive a decade of economic chaos completely unmanaged. Doing absolutely nothing only generates enormous wealth if your initial selection of assets is flawless. To find these rare companies, we apply a strict data-driven elimination process to thousands of listed stocks. First, a company must have a market capitalization of over 100 crore. This immediately filters out the smallest businesses and ensures basic institutional reliability. Next, the company must prove extreme consistency. We filter for businesses that have delivered at least a 10% sales growth every single year for the past 10 consecutive years. Finally, we look at a metric called Return on Capital Employed, or ROCE. This simply measures how efficiently a company turns its available capital, its debt and equity, into raw operating profit. This return on capital must remain strictly above 15% for a decade straight. This proves the company can consistently beat the baseline cost of capital in the market, year after year, without fail. Out of roughly 1,500 eligible companies, only a tiny handful survive this gauntlet. Once you isolate these rare survivors, you buy equal amounts of each and do absolutely nothing for 10 years. No rebalancing, no panic selling. True wealth-building companies are incredibly rare. The strict mathematical rigor of finding them is exactly what earns you the right to step away and stop actively managing your money. This chart shows the historical performance of this seemingly lazy strategy over a 10-year timeline. The steep exponential curve represents the coffee can portfolio, which has historically yielded a median compounded annualized return of 24 to 25%, drastically outpacing standard market indexes. The ultimate stress test for this portfolio was the 2008 Lehman crisis. While the standard market plummeted and wiped out active traders, these high-quality companies absorbed the massive economic shock, remained resilient, and quickly curved back upward. The financial industry thrives on a frantic, adrenaline-fueled culture of rapid-fire trading and constant intervention, but the reality of actual, sustainable wealth creation is incredibly boring. Building serious wealth doesn't require outsmarting the market every single day. It simply requires the discipline to select exceptionally high-quality businesses and the patience to step back and let compounding do the heavy lifting.